Hey, what's up guys? So today we're going to investigate the relationship between Tesla and its industry and how that affects valuation. So a big thing right now is a lot of analysts, when they look at Tesla, the big question that's debated is it an auto company or is it a technology company? So today I want to look at that and see what are the drivers, first of all, of value, number one. But number two, depending on the industry that we are categorizing Tesla in, what characteristics of that industry drive that valuation? So for example, if we use the characteristics of an traditional auto company and the auto industry as our drivers of valuation for Tesla, will that be different than the drivers or characteristics of a technology company? And so to do that, we can use something called cross-sectional regression, and that's what we're going to do. So let's get started. Let's build this out. So first things first, as you can see here, we need to import pandas. The data frame or the data that I'm going to be using is going to be coming from FinViz. And so you can download a CSV file from them. You need a premium account. It's like 30 bucks, but I've already downloaded it here. And so now we can take a look at what our data set here. And in the previous videos, we've used this data set before. So in determining our cross-sectional regression, we're going to use something called a market-based valuation. And that is something called a price multiple. And specifically, we're going to look at the price multiple, the common one, PE ratio. So PE ratio is an interesting thing, and it has a lot of good qualities and negative qualities as well. One of the good qualities is that it's very commonly used, and it's understandable. A negative quality is that when you have a company that does not have any earnings or negative earnings, for example, it's not really a very useful measure at all. But what you can do is you can take the inverse of the PE ratio and get the earnings yield. So that's what we're going to do here. And before we begin that, we want to understand what are the drivers of PE. What's the drivers of a PE ratio? And so there's several ways we can look at it. If you go back to the original idea of the Gordon growth model, you can use that as our starting basis. So what you'll find is that the PE ratio, what the drivers of that is, it's a function of two fundamental characteristics, and that is the growth of the rate of dividend, the dividend growth or cash flow growth, and it's also the function of the stock's required rate of return or risk. And what you'll find is that greater values of growth will equate to a greater PE ratio. That is the growth of the dividend or the cash flow. And also greater levels of risk or the required rate of return will indicate a lower PE ratio. And so now that we understand some of the basic fundamentals of the PE ratio and what drives it, we can begin to hypothesize about what variables we can use to build out our model that drives that. And so let's take a look at some of the variables that we do have available to us. So we have the PE ratio. We have earnings per share growth over the next 5 years, past 5 years. We have earnings per share growth quarter over quarter. That's an interesting one. So that's last quarter's earnings per share growth. We have sales growth quarter over quarter. We have profit margin, operating margin, gross margin. Those all equate to at the bottom line, the earnings, and then eventually the dividend or cash flows, right? And finally, we have volatility. We have volatility of the week, volatility of the month. This could be our indicator of risk or a measurement of our required return. We even have beta in here. So let's pull out some of this information. So what we're going to do is first, let's create our earnings yield. And so remember, some of this data is going to have negative earnings, and using a PE ratio of a company with negative earnings is not intuitive. So if we inverse that, we take the inverse, we can use the earnings yield, meaning that a higher earnings yield will indicate a low PE ratio, a low earnings yield would indicate a high PE ratio. And so we can rank the stocks by earnings yield rather than PE ratio. And it's a little more intuitive. So let's try to do this. So first, let's take out we're going to call something called earnings per share. And you'll notice when you're looking at the data And so I'm taking the earnings per share trailing 12 months. So that should be right there, TTM. So you'll notice, and let me output this first so you can see what I'm looking at here. We have numbers here, not a numbers. What we want to do is we want to take this number and divide it by the price to get our earnings per share, or our earnings yield. So to do that, we're just going to take that column divided by the price column, and we're going to say that is equal to the earnings yield. And I'm just going to abbreviate it with EY, and that should be that. There we go. So take a look at that. There we go. Now we have an earnings yield column in our data set. The next thing that we need to do is let's take a look at some of these other variables. So let's look at gross margin first. So you'll notice that gross margin, it has a percentage sign here. We need to remove that percentage sign, and in previous videos you should see how we've done that before. So all we do is we take the apply function, and we're going to use a lambda function, so lambda x. So for every value of x in this column, we're going to take that x value, make sure it's a string, so str, and then from that string we're going to strip off that percentage sign. So I'm going to strip off that percentage sign, and finally, once that is converted, we'll convert it to a float. So a float is just a decimal form, and divide it by 100. So now we had 54.5%, now we have 545. So there we go, and now we have data that we can actually work with here. We're going to want to do the same analysis. We're going to do the same conversion to all these other ratios. So we're going to look at the profit margin, operating margin. You'll find that the earnings per share growth over quarter, and sales growth are in the same format of this percentage sign here. And so we're going to remove that. So I'm just going to add these in right now. So there we go. I added those in. I converted the formatting to actual working data. So we have OM, which is operating margin, PM abbreviated for profit margin, return on equity, sales growth quarter-over-quarter, earnings per share quarter-over-quarter. And finally, I wanted to look at this last variable, and that is volatility. And that is over the month. We're going to use that as our measurement of risk. And volatility. And again, for this one, we also need to strip this out. So we're just going to add that in there. There we go. So now we have our data that we want to work with. Let's take a look at the industries that we're interested in. So we have the specific variables that we want to look at, but let's look at these variables in terms of their specific industry. So to do that, we can look at the industry column, and you'll notice there is a column here called industry right there. So we can say industry, and I'll get a list of this, but what we want to know is we want to get the unique value. So we can just say unique with parentheses, and there we go. We can see all these unique industries that we're interested in. We're going to look at the auto industry. And so if you scroll through here, you'll find there's something called auto, major auto. So what you'll find is auto manufacturers major is the specific column that we want of data. So to get that, we're just going to say, we're going to take our data frame, and specifically we're going to look at the industry column. And if the industry column is equal to auto manufacturers major, that's what we want. And so these are all the auto manufacturer majors, all the auto manufacturers that we're interested in. You'll notice about 14 of these, I believe. Yep, 14 rows. So we're going to create a new data frame here, and we're just going to call this auto DF for auto data frame. And great. So now we have that. Print that out so we can see that. Now what we like to do is we want to specify the variables that we're interested in that we specified earlier. Again, those were the earnings yield, gross margin, etc. So to do that, I'm going to create I'm just going to modify our data frame, and I'm going to look at the ticker column. And remember, you need to put it in 2 brackets here. So we're going to look at the ticker column. We're going to look at, we'll just throw in price, just to see that, even though we won't be using that. We'll have the earnings yield, the sales growth, gross margin, operating margin, profit margin, return on equity, earnings per share, growth, and finally we're going to look at volatility. So there we go. And we didn't add gross margin here. So what we need to do is we need to say we didn't add a column for gross margin, so I'm just going to put that in there like so. And let's start at the beginning here. There we go. So now we have all the variables that we're interested in. We know we are in the auto sector. We're looking at all the auto companies and these variables. So yeah, in our next video, we're going to actually build out our model and look at specifically the relationships between these variables and earnings yield. We want to see if there is a positive or inverse relationship, a strong relationship, and if so, we can put those into our model to help us value the true value of Tesla. You'll notice Tesla is actually in here. So if you like this video, please subscribe. Till next time, guys. Thank you.